Welcome to a new episode of the Opening Bid Podcast. I'm Yahoo Finance Executive Editor Brian Sozzi. Like I always say, it's the podcast that will make you a smarter investor, period. And you're, of course, going to get smarter off of this next featured guest. Joining me now on the pod at the NASDAQ in Times Square, it's Mike Pyle, Deputy Head of BlackRock's Portfolio Management Group. And Mike, I got to tick through some of your prior positions here to set the stage on everything you've done. You are the former Deputy National Security Advisor for International Economics during the Biden administration. You were the Chief Economic Advisor to Vice President Harris in her first year. And of course, you worked in the Obama White House. So, I mean, you've been a busy guy the past 10 years.
Something like that. Plenty to keep me occupied.
So if I have it right, you help lead, what, $3.2 trillion in assets under management at BlackRock?
So the Portfolio Management Group at BlackRock oversees our active investment strategies in public markets across asset classes. So active fixed income, active equities, active multi-asset. So a range of different strategies, and we're fortunate to get to manage assets on behalf of a lot of clients globally.
The way I summarize it, it's a tough gig. It's a tough job. So I was trying to think of a way to get this going, and I love what the Wall Street Journal wrote recently. They're calling it, it can be an uncomfortable summer for the economy. Would you agree with that?
Yeah, listen, I think that uncomfortable in the sense that there's a lot of uncertainty out there, but I think if you take a step back, right now the underlying momentum of the economy still seems relatively healthy. And we got, of course, the most recent pulse check on that on Friday. A pretty solid employment report, unemployment hanging steady. Yes, there seems to be some modest step down in economic momentum. I think, yes, there's a shock that we're beginning to work our way through, both on the growth side and on the inflation side, from the trade policy uncertainty and the fact of tariffs. But, stripping that away, it does continue to look like the underlying momentum is still relatively healthy.
Is the next step off a cliff? And I asked this because, I saw that jobs report, 139,000 on the headline, but then the prior months were revised lower, sharply lower, in my view. So we had weaker growth for the employment market prior months. We had a headline that's below that 200,000 growth rate we saw in many respects under the Biden administration. What is that next move in the economy?
Listen, I think that it's not surprising to me that we're seeing some step down in the underlying economic momentum out there. You think about a couple of things. One, net immigration is now considerably lower than it has been in past quarters and years. That means that the break-even level of job growth month on month is just going to be less, even for a comparatively healthy economy. And like I said, there is a shock playing out because of the trade policy changes that we're seeing. That's going to play out both now and in the months and quarters ahead. That's going to cause growth to step down. That's going to cause prices and inflation to move somewhat higher, at least temporarily. But I think those things can coexist against an underlying economy that still continues to grow, continues to expand at a healthy, even if slower rate. And I think that's what we mostly saw in the jobs report and what I would expect to continue.
Why do you think the economy hasn't slipped into a recession?
I think the economy at the end of the day in the U.S. is, a dynamic, resolute, healthy one. This is an economy that, has among the world's leading corporations, the world's leading innovators. It's incredibly dynamic on its own terms. There's a reason why, if you roll the clock back, just 5 or 6 months ago, the question investors were asking is there any place else in the world to invest but the United States? Because of that economic dynamism, because of the innovation of our corporate sector, our technology sector. So I think, let's just remind ourselves where we were 5 or 6 months ago. And where we were 5 or 6 months ago was, the United States is a world leading economy. The things that made that true then are mostly still true now, even in the face of some of the uncertainty and policy shocks we've seen. And I think that if you're looking for why the United States continues to be, I think, a relatively healthy economy on a relatively healthy trajectory, that kind of underlying structural strength is where I'd point.
As someone that was in the trenches during the Biden administration working on various economic policies, is this an economy you think that is still benefiting from a lot of those policies that the prior administration put in? I talked to, I remember smack in the middle of, maybe towards the tail end of the pandemic, thinking about all the investments that the administration put forth, and I think of chip production. I remember talking to the CEOs of Intel and AMD and how they're now, at the time, were spending billions of dollars to ramp up their businesses because of that. Is the economy still feasting on that momentum?
I mean, I think that what you highlight is the fact that the problem that this administration has pointed itself at, the problem of our manufacturing capacity, the problem of our industrial capacity, is not a new problem. It's something that President Obama focused on. It's something that President Trump focused on in his first term. It's certainly something that President Biden focused on, and now it's something, of course, that President Trump is focused on in his second term. I think that, exactly to your point, whether it was the Chips and Science Act, whether it was the Inflation Reduction Act, a lot of the relatively kind of robust health that we saw in terms of investment into manufacturing and the industrial economy was, showing real momentum, real signs of bearing fruit. And I think, a lot of that momentum from the last couple of years is persisting into this year. The hope is that we see that continue.
Do you think that the U.S. becomes a great manufacturing hub again? Of course, we have auto plants in here, but we've heard the Trump administration really lean into, of course, getting things made in the U.S. Do you think that happens, and what would that mean for the economy?
So, listen, the way I think about it is, we are engaged in a very significant geopolitical competition with China that has a bunch of different aspects to it: economic, technological, financial, many other respects as well. And it's important to have a robust manufacturing sector, a robust set of industrial capacities, precisely because our national security demands it. But I think what we were pointed at when I was in the Biden administration was looking to work with our allies and partners to have the broadest based set of international partners that we were working together with to achieve those ends. And I'm hopeful that as we get deeper into the Trump administration, as they focus on how we're really going to expand industrial capacity in ways that serve our national interests and our national security, that that same spirit of recognizing that we've got to do this together with others, in addition to investing in ourselves, is the order of the day.
Yes, as someone that worked really closely in various negotiations with China, other Asian countries, I talked to a lot of CEOs, and they're moving aggressively out of China, their supply chains. What impact do you think that will have on the Chinese economy, but also to our relationship with them over time?
Yeah, I mean, I think that this has been a long-standing trend, I think really dating back to the first Trump administration. We saw a tremendous amount of relocation of investments and trade activity away from China into economies in Southeast Asia, Mexico, other important economies around the world. That, I think, only continued in the Biden administration. I would expect to continue during this Trump administration as well. I think it reflects the fact that this is a world that's fragmenting geopolitically. It reflects a world where companies that are making investment decisions want to do so in a way that balances their risks and recognizes that the producing in China carries a different set of costs and benefits than it has historically, and being sure that they're diversified both in terms of production here at home where possible, production in other economies that don't have the same kind of risk associated with them, being sure that they're resolute and resilient to the types of shocks and fragmentation that have happened and will likely continue to happen. That's what's in the best interests for them as a business, and I think ultimately reflective of, like I said, these underlying trends.
So is this tariff policy by the Trump administration, I think we can agree it's been chaotic and all over the map, but at its very core, hasn't been good? Has it been good for the U.S. economy?
So listen, I think that the core feature we've seen thus far is a lot of uncertainty without a great deal of clarity in terms of where this is ultimately going to land. And I think that, a couple things. One, the tariff policy that we're seeing, regardless of where it lands, is going to be a negative shock for U.S. growth. It is going to be a positive shock for inflation and the price level. And so in that sense, it is going to cause short and medium term dislocation and less growth than we would otherwise see. I think beyond that, the uncertainty is itself its own driver of economic of economic softness. As we were talking about before this aired, corporate executives are, right now kind of frozen.
They're totally frozen. I can't tell you how many executives were telling me, yeah, we're getting ready to go into 2026 budget planning season, and we have like 8 different scenarios, and a lot of them suck.
Yeah, and so, I think we were talking about before about that momentum in industrial investment, manufacturing investment around chips, around data centers, around energy infrastructure. Those are the kinds of things that are being disrupted because of the uncertainty, because of corporate executives, corporate leaders waiting to see where policy lands, where they can rely on it before resuming those investments. That's the kind of disruption that concerns me in terms of both the underlying trajectory of investments and capacity over time, but shorter term, about how big that step down in growth has to be.
All right, hang with us, Mike. We're going to go off for a quick break. We'll be right back on Opening Bid. Welcome back to Opening Bid, and we're here at the NASDAQ in Times Square having a great chat with Mike Pyle, Deputy Head of BlackRock's Portfolio Management Group. This has to be prime time for you in the sense that you have all of this international economics experience, and we're coming up, on the key date for the lifting of the pause between China and the U.S. on tariffs was July 9th, I believe. What are you telling investors right now as we get to this critical date?
Listen, I think that as we were talking about, this is a period of heightened uncertainty. And I think that one of the things that's been really noteworthy looking at markets this year is that heightened uncertainty has manifested itself in very large swings in investment sentiment, and swings in investment sentiment that are far greater than the actual underlying changes in the fundamentals that we've seen to date.
Economy might be growing slowly, but it's still growing.
Absolutely.
Recession hasn't happened yet.
Yeah, and may well not.
Yes.
And yet we've seen, at a minimum, 3 very different investor sentiment regimes year to date. Again, you roll the clock back to the start of the year. It was, U.S. exceptionalism, uber alles. There was no other place in the world to deploy capital but the United States.
The excitement, I was at Davos, the World Economic Forum, at the end of January, and you thought we were going to get GDP growth in the U.S. of 10%. I mean, the optimism on the ground was absurd. It was just, I had never seen it.
In many ways, I point to that moment in late January.
That was like peak hype.
Exactly. But if you roll the clock forward from there, like literally 6 weeks, everything was reversed. The end of the dollar, the end of U.S. exceptionalism, just the nadir of, investor views towards the United States and its long-term health and well-being. And then, kind of post the pullback in the global tariff post, in particular, some of that temporary respite with China, you've seen investors move to a considerably more constructive and I think kind of more balanced place. And I think, where I think we're at is a place where you have to be able to hold two ideas simultaneously in your head that are a little at odds with one another. One is, yes, again, this is a trade policy shock that's going to mean growth is lower, that's going to mean inflation is somewhat stronger. It's a trade policy shock that in the medium term is going to leave us with the costs of uncertainty that we've talked about. But at the same time, the US is still the world's most dynamic economy, the world's most innovative economy, the world's most resilient economy, and that basic underlying structural health can continue to shine through in terms of ongoing economic expansion, shine through in terms of financial assets continuing to perform, even in the face of the shock that means that things are perhaps less good than they could be otherwise.
Are investors, though, still, are they too optimistic right now? A lot of executives are telling me they're pushing through double-digit price increases. And we still have tariffs on. It's unclear, to your point, there's considerable uncertainty what happens between the US and China relationship. Are they just forgetting about some of the dynamics that are happening?
I think, our view in the face of broad uncertainty, in the face of, I think, a set of questions that are going to shape the global economic environment in pretty profound and tectonic ways over the coming 2, 3, 4, 5 years, is it's pretty hard to forecast where things are going to head on that type of horizon. Making kind of big bets one way or the other directionally is probably not the right way of approaching investing from the perspective of a mom and pop investor or a large institutional investor. I think what the moment calls for is a couple of things. One, kind of sticking to your knitting, staying invested, staying close to your strategic asset allocation, but bearing in mind a couple of things. Diversification and return is harder to come by. And so looking to strategies that can be relatively uncorrelated from these big directional moves that can generate that diversification return, things like market neutral strategies, including hedge funds. We think that has a really important role in portfolios. And then I think secondly, thinking through geographic diversification more carefully. There's been one trade that's really worked over the last 15 years, and that's being long the United States versus the rest of the world. I think it's totally plausible that continues to play out. But sitting where we sit today, being more thoughtful around some of those geographic exposures, asking if, as opposed to being overweight the US and underweight the rest of the world, underweight Europe, makes sense, maybe being more neutral weight. Maybe that's the right way of thinking about being balanced and resilient against a bunch of different potential outcomes of the coming 2, 3, 4, 5 years. Those are the types of conversations we're having with investors, and we think that that's the best way to navigate this uncertainty sitting wwhere we sit today.
I was joking. I'd love to get your, in the final 2 minutes, we always get a hot take from our guest. I was talking to Rick Reeder, of course, BlackRock, friend of the show, so to speak, and we were talking a lot about the debt situation in the country. When you talk to investors, are they really that concerned about the country's debt and what it might mean for markets, whether it's stocks or fixed income, or is this more of a daily headline-driven story and it's maybe something investors shouldn't pay a lot of attention to?
Listen, I think it comes up in my conversations with investors much more regularly today than it did, winding the clock back 4 or 5 years.
Yeah, we talked about the bond market 5 or 10 years ago.
It's a lot more prominent a feature in conversations today. I think as prominent as it was back in the early 2010s when kind of deficits and debt were last really in the headlines. I honestly think that investors today are more rightly focused on our fiscal trajectory today than they were 10, 12 years ago. I think 10 or 12 years ago, actually what we needed was more fiscal support of a low growth economy. Today, I do think the deficit and fiscal picture is potentially much more risky, is potentially at risk of crowding out investments and consumption because of the push in interest rates higher from the types of debt and deficits that we're seeing. So I do think that investors are rightly focused on it, and I think one reason why Rick and others at the firm are pretty cautious on longer dated government bonds, including treasuries, is this kind of fiscal picture is going to put upward pressure on those rates on term premia, out over the medium-term horizon.
In our time, we're still young guys, but nonetheless, we're never not going to pay back our debt. I mean, that's just not going to happen, right?
So listen, I mean, I would say, to jump ahead with my hot take, I'd say at some level, my hot take is, I think investors are right to be concerned about our fiscal picture, I think, for all the reasons that we just described. And yet, when I look at American history, I see examples of how our political system was able to come together and really change our fiscal trajectory in ways that ultimately put us on a solid footing. But that doesn't happen overnight.
No.
If you look at the period that perhaps most rhymes with our own, the period in the late 70s, early 80s, mid 80s, early 90s, where fiscal policy did look unsustainable, where it was front of mind for investors last time, the United States across parties over a 10 or 15 year horizon really embarked on a bipartisan effort to reduce deficits. And it didn't happen all at once. It didn't happen overnight, but on 5 or 6 different occasions across 15 years, either one party or both parties came together to take a bite out of that deficit. And again, over that course of a decade and a half, we adjusted our fiscal trajectory by about 5 percentage points of GDP and put ourselves on a much more sustainable path. I think a good state of the world is one where we see that happen again, but we have a relatively recent historic episode in both your and my lifetime, even as young guys, where we've done it before.
Yeah. Well, I'm an optimistic guy by nature, so I appreciate your optimistic hot take. Mike Pyle, Deputy Head of BlackRock's Portfolio Management Group. Good to see you in person. Appreciate it.
Thank you.
All right, that's it for the latest episode of Opening Bid here at the NASDAQ in Times Square. Continue to hit us with all those hearts and thumbs up all over the podcast platforms and YouTube. Love your feedback. And if you want to know a little more behind the scenes from this episode or had questions, of course, hit me with the comment sections on YouTube or on Twitter at Brian Sozzi, or I should say X at Brian Sozzi. We'll talk to you soon.